The following is a paid program. The views and opinions expressed are those of the sponsor and do not necessarily reflect the views of Radio 1, WTLC AM 1310 The Light, and its management.
Welcome to the Home and Finance Show on AM 1310 The Light. Now it's time to get straight talk about financing a home and insider information about buying a home from the experts. And here they are, your hosts, Janis Bradley and Diana Rice-Wilkerson.
Good afternoon and welcome to the Home and Finance Show. We are your host. I'm Janis Bradley, owner-broker of JB Real Estate Consultants, and my co-host.
I'm Diana Rice-Wilkerson, loan originator with Fairway Mortgage.
Home and Finance, as you know, is designed to educate our listeners regarding the process of purchasing, building, selling, or refinancing a home. And as you know, we tried to provide straight talk about what's involved in each of these situations. Given that home ownership is a cornerstone to America's promise, we believe that everyone who desires to own a home deserves access to the best price, highest quality products in the marketplace for which they can afford. That said, if you are in the market to refinance, build, buy, or sell a home, and you've not yet chosen a realtor or lender to represent you, Diana and I would be blessed and honored if you would consider us. You may reach Diana, and Diana, your number?
My number is 317-402-5555.
Or you can reach me, Janis Bradley, at 317-590-7348. Our radio show is accessible by the way of phone. As you know, you can call us at 317-239-1310. You can reach us on Facebook, website, or Twitter, enabling you to ask any of your compelling questions that you might have live time. Please go to our website at HANDFinanceshow.com. That's homeandfinanceshow.com. We have a team of experts that are waiting to give you any updated information frequently. Now, on with the show. Diana Rice-Wilkerson, how are you today?
Yes, ma'am. I'm great because the weather's good.
I'm telling you.
And it's all good, and we're probably going to all have some kind of bug before it's over. But nonetheless, we're going to enjoy every moment.
I always smile when I come down Spring Mill Road, because when I see the golfers out, this is February.
Oh, yeah.
And of course, you know, my husband played golf and managed golf, and it just always makes me smile, you know, to see they can't wait till they get out, you know. And they were out.
Yeah.
They were out. Yep. They will be out.
And many of their spouses couldn't wait till they get out.
Oh, absolutely. Absolutely, because they will stay all day. You know, absolutely. So, you know, what can I say? And we know that, again, let's just get back to the show, but we appreciate our listening audience. Absolutely. And the support that they have given us. Got one late afternoon, and when she called me and said, okay, now are you the lady on the radio? I said, yes, I am. And so she said, okay, because I've been listening to you. and it just makes you really, you know, feel so good.
Yes,
you know, so I always, it's not that we don't give everybody our undivided attention, but I tell you, if you say you're from the radio show,
Absolutely.
you're going to get that phone call right back as quickly as you can. Diana, anything happening in the lending?
Oh, God. Yeah, a lot's happening in lending, but we're going to talk taxes today. However, there's one thing I want to mention for sure. As you know, last summer, how we handle student loan payments and student loan debt changed dramatically, and it created a lot of problem for those who had substantial student loan debt and were trying to buy a house. Well, little bit of update and news. For those especially who have sizable student loan debt, I'm going to say try this no matter how much student loan debt you have if you're looking to buy a house. Go to, I think it's studentloan.gov, www.studentloan.gov. Go to the payment estimator and make sure all of your loans, they should automatically populate, because this is only going to work if all of your loans populate. And the payment estimator, like, you have to log into this, so it's going to know it's you. And the payment estimator should show you your options for repaying your student loan debt. And what is cool is, especially if you have sizable student loan debt, like I'm looking at a client of mine who has $100,000 worth of student loan debt, one of his options is called extended fixed. And extended fixed means that we now know what his payment is going to be over, I think it's a 25-year period. Now, that's not to say he's going to take that option.
Right.
But that's to say that is one of his options. Well, FHA, they give you 2 or 3 ways of looking at this. And one way is if you have what's called a fully amortized payment, meaning that if this person continues to make this specific payment over a designated period of time, they will, in fact, pay off the debt in full. No balloons, no graduated, no income base, that, they have to make this payment. Well, for my customer with this $100,000 debt, if he were to choose this extended fixed, then his payment would be $548.41, and so we would be able to use that payment
instead of the 10%,
of the $1,000 payment.
10%, right?
1%.
1%. Excuse me.
It's dramatic,
Wow.
guys. That kind of reduces that payment in half. Now, I'm not saying every lender is willing to look at it that way. You'd be surprised how we do things, but that is an option.
That is unbelievable,
and it's unbelievable. And I think, I'm being told that it could work. What I don't know is when you get this extended option. I'm hearing that you have to have at least $50,000 maybe worth of student loan debt before you get this option. That does not need to be true. I need to do a little bit more checking.
Right.
But the key is go in there. I mean, if you're walking around with student loan debt, or if a lender has told you your student loan debt is causing you not to qualify, and I would have been one of those people over the past year if you had sizable loan debt, didn't know about this option. So again, go out there yourself, educate yourself, so you'll be able to know, your own debt ratio. But go out there to www.studentloan.gov, and you want to go to the payment estimator. It's important that all of your debt populate, and then you want to look at what it says would be your payment for the extended fixed, not extended graduated, not income based. Call me if you have questions, 317-402-5555.
See, that's what I'm talking about, straight talk.
Straight talk.
Straight talk.
Insider information.
Insider information
Yes.
comes from Home and Finance Show. I mean, and that is so great to hear.
Yes, it is.
1% was 1,000.
1% is 1,000.
And so now we know
it could possibly
500.
be half.
Yeah.
Yeah, and the rate, listen, just don't think, like I'm looking at my client's information, he has a pretty low rate. That doesn't mean that's going to be your rate, right? Maybe for you
but
it's
we're
not.
options. It's all about having options.
Exactly.
In today's market,
Yes.
that's what we're dealing with.
Exactly.
See, FHA thought they were going to stop us, but not the dream team, huh? Home and Finance. Real quickly before we get into our guests, and as you know, our guests are the best of the best.
Amen to that.
I love that rhymes. It's not that, we purposely did it, but it's just the way it is. But anyway, just wanted to kind of remember to share with the listening audience how Indianapolis remains a seller market. It just still remains a seller's market. Give a little snapshot, some information about some statistics here is that we had a year, almost 5% increase closed sales in December. 5%. So this market has just been great. It's still going to be continuing great. There's a lot of information that Diana and I are going to share with you the next time that we're on the air. I just want you to know that, again, you can be part of this 2017 increase in home ownership. So I tell you what we're going to do. We are going to introduce our guests. We've got Gail Barnes, who is from Barnes Financial Services. And telling you, Gail is the bomb, you guys. Let me tell you, she's the bomb. Every time we introduce her to someone, they end up being her client in 2 seconds or less. I was talking to one of our team members the other day, and I just said, I don't know what the comment. I might have said something. I just said something about Gail, and she said, I said, do you remember her when we had the meeting? She said, remember her. She says, she says, I'm her client now. So I said, okay. So, Gail, on with the show. Why don't you just take a minute and just introduce yourself, who you are, what you do, and
contact
are we ready
information
for you? And all
Yes.
the contact information, absolutely. And don't forget, throughout some of the conversation questions we may ask you, Gail, because you have a fabulous newsletter. So don't forget maybe to let the listening audience know how they can sign up to receive your newsletter, okay? All righty, Gail.
Okay.
Who is Gail?
My name is Gail Barnes, as they say. I'm the owner of Barnes Financial Services. We've been in practice for a long time. Maybe go close to 30 years.
Mm-hmm.
We do accounting, bookkeeping compilations, financial planning, and tax preparation. Our main niche is doing financial planning and taxes. So we've been around. I have an office in New York. Is also an office here and office in Houston. So that's where we are. So we do that. So if anybody needs any assistance with taxes or accounting, just let me know. My phone number is 317-663-8452. And we're located at 8935 North Meridian, Suite 113.
So you can handle anybody around the country,
Yes,
is what I hear you
we
saying.
do. We do people out of town, in town.
And also, before we go into our 10,000 questions, we have
10,001.
at our website, which is homeandfinanceshow.com. If you go to the website, scroll down, you will see a list of our partners, their contact information, of which Barnes Financial is one. So if you're not in a position to write down any information, just remember to go to our website, homeandfinanceshow.com. Go to the bottom, and you will see Gail's logo, and you can click on that. That's going to take you to her website and give you her contact information.
Fantastic. All righty, Gail, where do we start? Okay.
I want to start.
All right.
I want to start with taxes because I just think there's just a lot of basic information people don't understand.
Don't know.
You know,
That's true.
and one of the things I think because as a lender, I hear all kinds of things. Who has to file? I mean, people think maybe if they're a certain age, they don't have to file and they make money. They think if they don't make a certain income or income doesn't reach a certain threshold, they don't have to file. They think when they get to a certain older age, they don't have to file. Mm-hmm. So who has to file?
Anybody who has taxable income over their standard deduction and exemption. So, for example, if you were, say, a single person, I would say basically if you made over $10,000, you're going to have to file. Now, you have a lot of senior citizens say, well, I'm retired, I don't have to file. But if they get a pension and along with other income, then they normally have to file. And other people may not meet that threshold of having taxable income, but if they had money withheld from their wages, then they need to file to get it back. So it's based on just how much income you made. And if you didn't make enough income, but you have taxes that were withheld, you want to file so that you can get that back.
Great. So filing may just be a matter of maybe not so much you're paying taxes, but you're getting reimbursed anything that's been withheld. And
that's a good question. People who own a business, there are other people, they say, well, I own a business, I didn't make much money, but the IRS is asking if you make over $400, you still file your Schedule C so that they can see.
Okay.
So,
over 400.
Mm-hmm.
Okay, well, I'll be sure to remember that.
Yeah.
Okay, so share with us anything that we really need to know that's changed with IRS.
One of the things that I think that is all on the news, everybody should be hearing about it, is the identity theft.
Okay.
It is so rampant this year. And the one that is really dangerous is the W-2 phishing scam. They're actually getting people's W-2s from their companies or when you send it online, and they're using that information to file taxes. And people think, oh, this is just one or two people. This is an organization. These are businesses doing it. They have made themselves a business. Some people may get the data. Other people may file the taxes. But it's a big scam that's going on. And they have the email scams. I know some of you may have got emails, and they make themselves like they may be your bank or your mortgage company, whatever, and they're coming and they're asking you to update your information. Be very careful about scams like that because they'll come to your email and they say they're the IRS.
So let's go back to the W-2 scam.
Right.
So,
I think that happened to a restaurant here.
Oh, yeah.
Started with that. It's a big restaurant. I mean, he was practically in tears. He's the owner,
okay.
Of how it affected, his employees.
So they're filing taxes in the person's name.
Yeah, I had a client. Two of them already called, and one, I was doing her taxes. And she called, she said, Gail, I just got a refund from the state, and it was a small one. And she said, and then, what's going on? I didn't know you had finished them. I said, no, I didn't. And so we found out somebody had gotten her W-2, and the thing was, those numbers were verbatim, just like on the W-2. So they had to get that original W-2 in some form.
Okay.
And they actually went and filed, and they fudged it so they can get a big refund. Well, the state knew that didn't make sense.
Yeah.
So they only sent her a small amount and told her to contact them. Once we did that, we also contacted the IRS and found out they were getting a large refund from her federal. And I don't know if many people have heard, but they had this new rule this year that if you get earned income credit or additional child tax credit, you could not file your return to get your refund until after February the 15th.
Yeah. Okay.
And that is really helpful because she would have been one of the ones that they would have went on and issued it if they had done it the old way. But since it was the 15th of February, they had time to pull it back. And the state and the federal and these software people, they're all working together on a form trying to come up with ways to stop this type of fraud. But the numbers were just like her W-2. So we don't know how they got it, but that's the type of things they're trying to put in place to stop it.
So it's not necessarily anything that the individual has put online themselves.
In this particular case, she actually emailed it to me. So what I'm doing from this point on, because some of my clients, they don't want to come in. So we're setting up what they call secure portals. Right. Or like a drawer, and you can put your data in. So I'm sending out emails to people, especially ones I know like to email them. Do not email them over to, just go into this portal I'm setting up. It's secured, and put your stuff in there. Because it is getting to the point where you don't know who's getting your information and where they're getting it from. They could have gotten it from her business. These businesses, they're sending out like emails to somebody in the business, and you're familiar with them. So they say, send this data. They send it. Yeah. And it may be a scammer doing it. Right.
And I think that's what happened with this company. It wasn't anything that the clients did, that the employees did themselves. I think it was another business that hit the accounting department and said something. I don't know. But, yeah.
Protect your information.
Just protect
your information. And even when you protect your information, in the case that you're describing, that does not necessarily mean that you're going to be totally safe. I mean, you still may be vulnerable. So I want to go back to this W-2. So are you saying that these businesses, these are like businesses that are set up to actually carry on this activity?
These are businesses. They're because I was just on a call about this, and we were thinking it's like one or two people, and some of these people overseas or whatever. They said, no, it's a business. It may be one group that gets the data. Okay. The other group that files the taxes or use it fraudulently in another way. Yeah. And it's just they're coordinating this effort, and it is really out of control.
Scotty's Bureau. That's what it was.
Oh, okay.
That's what it was.
Yeah, that's what it was. I remember hearing that.
Yes, he was on TV.
Another thing, too, email scams. They are coming and they're sending out emails, and like I said, updating things. And then be careful about online. Like I know I had happened to me. You may have a malware or a virus, and then it pops up and says, call this number. Yes. And you're so frightened, so you call the number, and they come in and they scan your system. And then that's where they're finding data as well. So be careful about that. People who are doing their own taxes, they're going out here using these different free tax softwares. Be careful that some of those softwares are not legitimate, people just trying to get your data,
and may not be as secured as they think.
As they think.
It may be a reputable entity, but maybe their stuff is not as secured as they think
they are. And one last thing about this scamming is, if you get a call saying that IRS, this is IRS, and you owe us this much money, and get us to you. A lot of people are getting those calls. Okay. Ignore them. IRS usually don't call you. And if you get emails, truly, they don't send emails. You may get a call every now, but not very often. And they do not send emails out to you. So if you get that type of thing, just ignore it or call the Attorney General's office or something.
Wow.
Yeah, I have gotten that. Not lately, but I think in the last 2 or 3 years, I can, and I love it because of the level of intimidation that's on the voice. For it just really, and I just said, well, I know they just don't have time to call me. And in fact, I think I did call you when that first happened, and you just said IRS just doesn't call anybody. So like you say. So anyway, tax credits. What are some of the tax credits? Or let's just go back a little bit. Is there anything else that has really been some major changes with IRS that help the taxpayer?
Well, mainly they're going to have a lot of tax law changes this year. Generally, it goes with the new administration. By next year, you're going to probably see a lot.
Okie dokie.
Yeah, so right now, the tax changes aren't rampant. Okay. But that was something that they're really telling us to tell people about the identity.
Okay. So tax credits, and how can they reduce your taxes?
Okay, there's several tax credits out there, and a lot of people miss them or don't realize that they can get them. The child tax credit, that's a credit that you get $1,000 if the child's under 17. Now, you can phase out if your income gets too large, but the majority of people get that credit. And if the child is under the age 17, they'll get a $1,000 tax credit.
And how does a tax credit? Okay, I'm the listening audience now, and I don't know a thing about taxes. So, how does that help me?
That reduces your tax. Say, like you end up having a tax liability of say $2,000. That credit will reduce it by $1,000.
Okay.
So it's a really good credit to have. And it's based on any child. You have 5 kids, you can get $5,000. So it's based on how many children you have under age 17.
Okay.
So one of the questions that I know I Googled, is there an age limit on claiming your child as a dependent?
It depends. Now, if it's 19 if they're not in college.
Okay.
But if they're in college, then they can go up to 23.
Okay.
You may carry as a dependent. I'm thinking earned income. As a dependent, you can carry your child as a dependent. I'm sorry. You can carry your child as a dependent up to 19. But if they live in your house and they don't have any income,
right,
you can carry them then as well.
And people should know that, I would imagine.
Yeah.
There's not an age limit then.
There's
if
not
they
an
live
age
in the
limit.
house
That's the question.
But you got to be careful
no
when you're doing it. If you call yourself head of household, or if you can just carry them as a dependent and be a single person. So that's the rules that you got to watch. Because if they're not blood relatives, you can't go head of household on them.
You know, we talked about this last year, and it seemed like it was a big deal to understand this head of household, how people claim head of household versus single family. I don't know.
There's a lot of rules with taking people as dependents, but the head of household has always been an issue because sometimes people live together. They've learned how to deal with the system, and they'll say, okay, if you go head of household, you can get the earned income credit, and I'll go single. You can't do that. If you're married, you got to go married.
That's what I wanted to make sure.
And if you get caught, penalties are high, so it's not worth it. I have had people do that, and they came in, and the situation happens. You go try to get a student loan, or get your kids in college, and then they want your tax return. Here you have got it wrong. You got to go back and redo all that. And then another thing with that too, they'd be surprised if when you file together, all the different breaks you get that you don't get if you file separate. So head of household is one that I would watch carefully that you don't do it. And then the IRS is also looking at if you put the same address down. And so like you say, you living together, you're not married, got the kids, and they say, well, he'll get more money than I will, so I'm going to let him go head of household and get the money. Well, the thing is, the tiebreaker rule is the person who makes the most money is the one that can take care of the kids. So they could probably catch that as well. So that head of household, you got to be careful that if you're married, you file married. And then another one, a good one too, if you're married, and a lot of times people have offsets. And offsets are like they owe student loan or they have child support that they're behind on. And so the IRS is pulling their money when they do their taxes. And so they say, I'm not filing with him or her because she's got this offset and they'll take my money. Well, there's a form you could file. It's called interest spouse. And if you file that, the interest spouse will get their credit or their refund. And the IRS will determine how much that's going to be. But many times they'll get all of it. Sometimes they'll break it up between the two. And then the person who's got the offset, they'll take some of their money. And then the person who is the injured spouse will get theirs. And the reason why that's important is because if you go married, filing separate, that tax rate is much higher, so which is going to lower your tax refund. Plus, there's credits that you can't receive, like earned income credit if you go married, filing separate. So that's another thing I try to let people know they need to do injured spouse rather than try to file separate because of an offset.
Take a minute and give your address. Your number, please.
Yeah, I wanted to say again, you're listening to the Home and Finance Show. Gail Barnes, who is our tax guru and financial planner and 10,000 other credentials, is in the studio. So you guys, I know you have questions. We want you to call 317-239-1310 with your questions. And Gail, if you would give out your contact information.
Yeah, my phone number is 317-663-8452. And my email address is barnesfinancial@sbcglobal.net, and my website is barnesfin.com.
And you can get that at our website, homeandfinanceshow.com. You can go to that website, scroll to the bottom, you'll see our partners. Barnes Financial is on there. You can select that logo, and it'll take you right to her website. And as you can hear, Gail does not believe in leaving anything on the table. You know, if you've got something coming back from Uncle Sam, then you're going to get it legitimately. And if a lot of people are having people file their tax returns who are not necessarily trained to have this information, you could be leaving things on the table. You could also be setting yourself up for some problems down the road, especially if you're audited.
Okay. Good afternoon. Hi, Linda. Thanks for calling in. You have a question or concern?
Hi. Thank you for taking my call.
Our pleasure.
I'm in trouble with the IRS.
Mm-hmm.
My husband and I was together at the time that we had filed together, but I filed, and I had no idea that he had some incomes I wasn't aware of. Then we separated. Then that's when I started hearing from the IRS saying we owe $10,000.
Mm-hmm.
So, am I liable? Am I responsible for that? But later on, after that, we got back together in the marriage. So what they had advised me to do was to file a spouse, I think is not knowing that he had income, some kind of form. But before I processed it or could do that, then we worked our marriage out. So now we're back. So now that is still lingering there on the table. And I've just been, ignoring the letters, because I, of course, don't have that kind of money. And I don't know how to proceed with that.
Mm-hmm.
Okay, so what they had told you to do is an innocent spouse. That's a little bit different than injured spouse. Innocent spouse is that you weren't aware of this and that you want to get out of the liability of it because you were innocent. And that's not easy to prove. And what the biggest reason why is that IRS, when you file and sign together, you're responsible.
For each other.
For each other.
Mm-hmm.
So the way to avoid doing that, if you feel somebody's doing something that you don't care for, you got to go married, file separate. But you can do an innocent spouse, but now that you're back together, you would definitely have to prove. And do not ignore those notices. Just do not ignore them.
Just call Gail.
Yeah.
Well, Gail, is this something you can help her with?
Oh, this something I can help you, but you need to get on some kind of plan.
Yeah.
Mm-hmm.
Because if you can prove that you can't afford to pay all that, they'll give you on a payment plan. They were willing to work with you, but they do not like you to ignore them. Then they can hit you hard.
Okay.
It's not worth it.
Give your number out again, Gail.
Yeah, my number is 317-663-8452. Yeah, give me a call. We can talk about how you can, there's different plans out there that you can
Did you get the
work with.
number, Linda?
Okay, 663-8452 and ask for Gail.
Yeah, ask for Gail.
Okay, I certainly appreciate that, and I'll be giving you a call. And thank you, ladies.
Thank
Okay.
you for calling. We appreciate
Excellent
it. Good luck to you.
Yes.
Mm-hmm. Hi, Brandy. How are you this afternoon? Welcome to the Home and Finance Show. Go ahead with your question.
I'm fine. How are you guys?
We're good.
Okay. I have a Form 1099 Social Security benefit. I am a payee for my daughter. Along with my taxes, is it necessary for me to file this paper that they sent me along with my taxes?
Is that for you or for your daughter?
For my daughter.
Oh, if it's for your daughter, you don't have to file it with your taxes.
Oh, okay.
How old is your daughter?
She's a minor.
Oh, okay. No, you don't have to file that. If she had income separately, she would have to file it with her taxes, but you do not have to file her Social Security with your taxes.
So do I need to keep this form or just toss it?
I mean, you don't need it for as taxes are concerned.
I say keep it in case you decide to buy a house if you haven't already, because we're going to ask you for it.
Okay. Okay, thank you.
Okay.
You're welcome. So, to her question, Brandy's question, for parents who have minor children that receive Social Security, right? They don't have to put that on their tax returns. They don't pay taxes. But if it was she would be an adult child that would be getting Social Security and also getting other income. I mean, what was the example where you said she would have to include it on her taxes?
If she had income of her own.
The child. Okay.
But like in most cases, they don't if they're minors.
Right, because they're minors, right.
But if she had, say, a job that she needed to file, she would have to put that Social Security on
She
there.
would?
And the reason for that it's like you or me. When we have income and we get Social Security, we have to file that Social Security.
Okay.
And it's taxable if we make too much income. And a lot of people don't realize
Only taxable if you make too much
Too much,
income.
because a lot of people
Okay.
come to me and they'll say, I'm at full retirement age now. I can get all the Social Security I want.
Yeah.
I said, yes, but you're still going to pay taxes on it if it's too much. You have too much other income.
Right.
And they allow taxes up to 85% of what your Social Security is.
Oh.
Yeah.
So they include it in there. So that a lot of people get confused. Social Security is taxable if your income is over a certain amount of money.
So let's stay with this Social Security or senior citizen situation for a minute, because I think that's a lot of people just don't know. So can you just kind of real quickly go through some rules and regulations? I know whether it's pensions or your Social Security, whatever. Like you said, the lady, we think we're retired and hey, it's us, it's ours now. So just
So if you only get Social Security, let's say I'm whatever age and I only get Social Security, do I need to file a tax return?
You do not need to file a tax return.
But if I get Social Security and also a pension,
you need to file only if that income is over that
threshold
for standard deduction, whatever. If it's lower than that, you still don't have to file.
Okay.
Now, most people I'm working with, they have pensions, and the pensions are pretty nice size. Then they have to file. And their Social Security is included. And sometimes if people decide, I'm getting my Social Security, it's mine, I'm getting it, and they're still working, but then they're usually a victim of having to file their Social Security. And then that adds problems to your taxes because now you got income that you haven't taken taxes out on.
Right.
So what I encourage people to do is you can take some taxes off of your Social Security. You can call them and tell them I want to take some federal taxes out. So,
good. I didn't know that part.
And another thing, too, is the state does not tax Social Security, only the federal.
Okay.
So you can go and have the the Social Security people take the taxes out so that you don't owe so much.
Now, is that up to a certain age?
No. Doesn't matter what age. Isn't that something?
Really?
Because I always say
I could be 99 years old
and still have to, if you have too much income.
Yeah.
And say some people, they be okay one year, then they take a draw off of a 401 and throw their income into another bracket.
So those are kinds of things before people, you guys, this is why I love this. And I love Gail, Janis, and I both do. When you have assets, you got to know how to protect them.
Yes.
And you also want someone you want to consult with before you make major moves financially. And that's why I love the fact that, Gail, you do the taxes, you do the financial planning, you do the whole entire bit. So again, we just want you to have access to someone who knows and would have your front and your back. Because that taking your money out of your 401k, I can see where no one would ever even think about the tax consequences of that.
And the other tax consequences of taking money out of a 401k or out of an IRA, or what they call, this is all qualified money because the money has not yet been taxed.
Right.
So when you take money, a distribution out, and you're not 59.5, you got that 10% penalty they're going to hit on you, as well as the taxes you have to pay. So I always remind my people, if you're under 59.5, let's talk about it.
Okay.
Just talk about it, see if it's worth it. Or maybe you could scatter it over certain years, but you don't need to take that much at one time and get penalized on it.
Okay, so go ahead. No.
So that early withdrawal is important, that you understand how that goes. And most people, they're retiring, taking a lump sum, it's best to roll it into an IRA, and you won't have to pay taxes.
Okay, that's definitely worth a call.
That's what I'm talking
and
about.
real quickly before I forget, which I did. Okay.
Well, listen, let's get anonymous.
Anonymous.
Hey, thank you for calling the Home and Finance Show, Anonymous. Please go ahead with your question or comment.
Well, I was wondering if you retire and you're getting your Social Security and then you get another job. Now, I had been getting letters that said I had reached the age where I could make as much as I wanted to, but you're saying that no matter how old you are, you still have to pay taxes. I mean, I know I have to pay taxes on the money that I'm earning.
What I'm saying is that it doesn't matter how old you are. If you have other income, and that income is over that threshold, which IRS allows you to make with Social Security, you got to pay taxes. And I'm just going to throw a ballpark. It's not exact amount, but like say if you're single and you make up a $25,000 in pension and other income, you're going to start paying taxes on Social Security. Doesn't matter how old you are. Does that make sense?
Just the ballpark is $25,000.
That's for a single person. A married person, maybe 34, 35. I would have to do the calculation. that if you make over that money in pension or any other type of income, then they start taxing your Social Security.
All right, then another question, and I'll be done.
It's okay.
I've gone back to work. Now, will I be able to add on to my Social Security when I retire from this job, or is it over? It's a done deal.
You didn't start taking it? You still taking your Social Security?
Yes.
Then it's a done deal.
All right, thank you.
Excellent questions. Excellent
Love
questions.
it.
What did she say? What she said? Is it a done deal? I love it.
And it's a good question.
Yeah, it's a great question.
It's a good
Absolutely.
question. I mean,
She's already
because you would
started
think you could kind of, okay, now I can start all over again
Yeah.
because I'm young. I can
Right.
feel good. I can work 10
Well,
more
can
years.
she also have? Okay, so she's back to this other job, this new job. Can she elect not to contribute to Social Security
No.
since it's a done deal? So she is still got to contribute. You know, some things just are not right.
That's
okay. So she still has to contribute to Social Security, but that is truly not coming back to her.
Mm-hmm.
Okay,
Exactly.
Good to know.
I want
Good
to
to
real
know.
quickly get back to this withdrawing from retirement plan, and I think I know the answer. So on occasion, we have clients who are withdrawing from their 401k of hardship, in order to get the down payment assistance and that type of thing. But if they're paying that back, that wouldn't be anything that's a tax issue, right?
So
I just want to make sure
they
everybody's
took it as
hearing
a
that.
loan. Then that's what you
Yes,
said.
that's
Yes.
Then
what
it's
it
not
is as a
taxable.
loan. Okay.
As long as they pay it back.
I just wanted to make sure that was that they heard that, because people, how we hear what we hear, and then we jumped off the cliff.
There's companies that have the loan provision with their 401, and
Yes.
if your company doing it allow you to take a loan, then you have to pay it back,
Yes.
and then that keeps it from being taxable. But I've had people who've done that, and then they leave the job and hadn't paid it back.
Oh, okay.
Then it becomes taxable if they don't pay it back.
Yeah.
Let's quickly do this, since this is the Home and Finance Show. Okay, let's talk about advantages for clients, sellers, or the buyers who have paid closing costs. Then we'll get into the MCC. But what exactly can they pay? Can they pay now? So a buyer, let's say they've paid their own closing costs or whatever. I mean, closing costs. Is it just going to be closing costs? Does it include prepaids? I'm not sure, but they did pay $2,000 in closing costs. Now, is that something they can write off?
But they can. The closing costs they can write off is your origination fees.
Okay.
That you may have gotten, and then
Discount points.
things like that you can write off. And then also you can write off if you got besides the closing costs, you still got your interest you can write off, your property taxes, your mortgage insurance, all that can be written off when you itemize.
Right, but that'll happen like almost a year later. But
after you have your mortgage.
But the closing costs, like this year, if I just closed, well, this is 17. So if I just closed on the house in December 16, then I can count those closing costs.
And a lot of the mortgage, when you get your mortgage statements, they'll have that stuff on there. They'll have your points and
So look for that.
Yeah, things like that you did at closing.
So there's only a few things.
And then there's another thing. If you look at the closing papers, I know sometimes they pay the property taxes. So sometimes we ask them, let me see your papers that you closed with. So if there's other expenses that you may incur that you can write off.
So what about the sellers? So if the seller paid a buyer's closing costs, can they write that off?
No, it has to be with the mortgage.
It has to be with the mortgage. Very good. So I can't use that to tell my sellers, I need you to pay these closing costs. Okay. We've got Judy on the line. How are you this afternoon, Judy?
How y'all doing?
We're good.
Okay. I had a question as far as foreigners, because I was told that they don't have to pay taxes for 5 years, right?
Who's this?
And I'm thinking, okay, when they buy a home and stuff, so do they go through the same as America, or do they just come in with welcome arms to oh, here's a house, you don't have to pay for 5 years? I mean, can you explain that?
Okay, I think you need to redo that first part of your question. I don't think we understood the words.
Okay, like Spanish or foreigners come in, and they don't have to pay for 5 years. They don't have to pay taxes.
Immigrants, she said Spanish or something. Okay,
I'm not aware of that because they get what they call IT-10 number.
A TIN number.
And it's just like a Social Security number, and they making wages. They got to pay taxes. I'm not aware of the 5 year.
And we get their tax returns.
And I'm not aware of the 5-year rule.
Oh, okay. I know a couple of people that told
Uncle
me about
Sam
it.
gets money from everybody.
I'll look that up, but you got my phone number. But I am not aware of that because I know they get that. They get a number just like you got your Social Security number, and they have to file taxes on that income.
Okay. What's your name? What's your name and number?
Oh, Gail Barnes. I'm at Barnes Financial Services. My phone number is 317-663-8452.
846.
No, 8452.
8452. I appreciate if you look it up.
Okay, I
will. That really upsets me because it's
I'm
like
not
they
aware of that.
come in.
Unless there's some kind of program out there that I'm not aware of. IRS don't usually let people go without getting getting some money. So I'll look it up for you.
And she's at the IRS conferences, that's for sure.
I never heard of that.
Hey, I got
and also on the, did y'all hear about the IRS? Russia was hacking in the IRS. Did y'all hear about that?
A lot of people hack the IRS. It's not just Russia. Believe me, they have had issues just like we were talking about the identity theft with their systems. So, they're really having to up their security as well. So it's not just if Russia has done. I haven't heard that one. I know they have done the other things, not the IRS. But I do know the IRS has been hacked before.
Sure. These people are brilliant.
It's crazy out here now.
Thank
you, Judy. We appreciate it. Good afternoon, Larry. How are you this afternoon?
Fine.
Good.
Just fine. I love you guys' show.
Oh,
Thank you.
Lord. Thank you.
It's really informative, and you do come across putting everything on the table. But what she was talking about is when you have a residential abatement for 5 years on property tax. That's when somebody moves into a certain area where the abatements are out, and they get an abatement if they buy a new home or do a certain extent of restoration on an existing home. So that's maybe what she was talking about.
Oh, okay, not filing tax. She's talking about property taxes.
Yeah, and that's only.
Okay, I hope she hears.
That's for anyone that meets the criteria.
Okay,
thank you, Larry.
Thank you for your show.
Thank you, Larry. We appreciate that call.
Yeah, I remember that happening in Fall Creek Place and other areas.
Yes.
We got Mayhem on the line. Hi, Mayhem. How are you this afternoon?
Hey, how's it going? I just want to commend you on a professional show.
Thank you.
The young lady was incorrect. Larry was right. They done that when they started redoing Fall Creek.
Right.
They getting people to move in and have to pay taxes 5 years.
You're right.
That wasn't foreigner. That was everyday people like us, Americans, that pay taxes.
Right.
And foreigners do pay taxes. That's a misconception. I wish people leave people alone that want to come over here and live a good life and get up and go to work every day and pay taxes. Leave these people alone. Thank you.
Thank you, Mayhem. I love it, Mayhem. Hey, I do have a text question, and that is, if a person's sole income is workman's comp, do they have to file taxes?
No.
No. Okay.
No.
Very good.
No, they don't have to pay. They don't have to file on workers' comp.
Okay. Excellent.
That's like insurance.
Let's talk about a couple other things too, especially dealing with homes. And we always want to talk about the mortgage credit certificate. Gail, do you see that often? Do you think that's something that seems to be something that a lot of buyers forget to do?
Oh, yes. I very seldom see it. But it's a credit that you get from your state or local government. And that credit is a tax credit against the mortgage interest that you pay. And one thing they need to know is that they had to be a first-time home buyer.
Okay.
But if the definition of a first-time home buyer, is a lot of people don't understand, is that if you owned the house and then got rid of it for whatever reason, and you didn't own the house for 3 years.
3 years.
Then you want to buy another house. Now you again consider a first-time homeowner.
Correct.
So that's one thing people may not realize, and that's why they don't do
We
it.
appreciate that. We try to share that all the time, but the fact that you're saying it also, helps.
And then the credit you can get is capped at $2,000.
It is capped at $2,000, and the thing of it is that's a lot of money.
That's a lot of money.
This benefit is not offered by all lenders. It's only offered by a few lenders, but it is a lot of money, and it can be used with any mortgage program. It does not have to be exclusive to some particular program.
A down payment assistance or what have you.
So it can be used with any mortgage program I need to qualify that, as long as it's not already a reduced rate or some kind of other first-time home buyer program, you know. But anyway, it's a lot of money. If you are...
Is it FHA and conventional? Or
It's any.
Okay.
Yeah, FHA,
Right.
conventional, VA, the whole entire bit. And what I think, I've never done the math, but it's got to equate to over $10,000 to $15,000 because it's a lifetime.
Yes.
It's a lifetime thing. It's 20% of the mortgage interest up to $2,000 every year for the life of the loan.
And not only that, if your calculation comes more than $2,000, you're allowed to take the difference over 3 years.
That's awesome.
So like it came to $3,000 instead of $2,000.
Yeah.
It's capped at $2,000 for that year, but then you can take the remainder over 3 years.
So you can actually pick it up somewhere down the line.
And you made a good point. There's a lot of money. $2,000 is a credit, not a deduction. There's a difference. A credit means dollar for dollar reduction. So say, for instance, you owed $2,500 in taxes, and you was doing your tax return. You get this credit, now you only owe $500.
Right.
So it's a dollar for
Dollar.
dollar. It's not just a deduction, but it's a credit that you reduce your tax liability.
But also,
needs to be
just to
put on the
further
website.
explain too, because I just know how y'all think, because this is the way I think. Since they're taking taxes out of my paycheck every pay period, and at the end of the year, I'm getting a tax refund. Let's say I'm getting my refund's $2,500, but I also have the mortgage credit certificate. Once applied, you know, I could potentially be getting $4,500 because it's not a rebate, but it sort of acts like it. And I use that word only because I know people understand rebate and refund over credit. That whole tax credit thing is just really it's a word that people just don't understand, but they do understand rebate and refund.
Yeah, and I know we've seen it in the past, and I don't know how many people actually do that or know they can do that when they can actually go and change their status, I guess, with their employer so that they're able to receive a little bit more money. They can apply that credit and receive a little bit more money each month to help make that payment. Because actually the lender actually uses that even as a credit for ratios, you know. So again, it's just we try to talk about as much as we can, but, you know, what can I say? Real quick question. You know, there's a form given at closing when a seller closes, closes on their home. So they don't have to pay, the seller does not have to pay, I guess it's like for each person, if there's two, if there's a husband and wife, if it's not over $250,000, then they don't have to claim that as income. That's what happens at closing. I mean, it's a form that as long as they've lived there.
You're talking about when they sell the house?
Yes.
Okay, yeah.
Yeah, when I said close, that's the magic word for selling.
As long as they don't make over $250,000.
Correct.
Yeah, that's true.
Correct. So now, how many times can that happen?
It doesn't have a particular like it used to be. I know you're talking about. There used to be you had a one time to do that, but now you can do it as long as you want.
I don't even know that I knew it was just one time. I mean,
it used to be like that,
okay.
but now they went up to $250,000. If you sell a house, how many people make over $250,000? But there are some. I had a client in New York. He bought a house for $25,000, and he had it for like maybe 20 years, and it was like over $1 million.
Deep.
So we had to calculate the capital gain on that one.
Yeah.
But very few people get over 250, so it's not something that they normally have to be concerned with. But that's, and it's not a one-time thing.
Is it a cumulative thing? Is it a cumulative thing? Like, okay, say I sell this house.
Any ideas?
No. Say I sell this house and my net profit's 100. Okay.
Oh no, it's not cumulative.
And then 10 years later.
No, you got to look at each house and look at the basis. When you come up with capital gains, you got the basis.
Yeah.
And then the selling price.
Okay.
Basis plus any upgrade.
Okay.
Expenses. And then the difference is your gain.
Okay.
So that's just for each individual house.
Okay. All right.
I think that's fantastic.
Hey, thank you for calling the Home and Finance Show. John, go ahead with your question or comment.
I just tuned in, and is your guest today a CPA?
Yes.
Okay. My question in regards to selling a house, and how does that affect the alternate minimum tax? And discuss that tax if you would.
Alternate minimum tax is for taxpayers over a certain amount of money, earn over a certain amount of money. So if you're going to, if you sell, that tax is like there's certain things they disallow for people who make too much money. And some of that money that they disallow, maybe the property tax on your home. that gets into a lot of detail when you talk about alternative minimum tax. But I guess I'm trying to understand.
So if you sold a house, for example, and you didn't buy another one, and would that push you into that bracket where you'd be forced to make that tax payment?
No, that's capital gains. That's two different things we're talking about. We're talking about when you sell a house and you say you sold it and you made over $250,000 in gain, then that's another calculation. That doesn't turn you into alternative minimum tax.
Okay. All right. Thank you.
It's a capital gains, potentially a capital gains tax.
Yeah.
Okay.
He said we have 5 minutes left, and he's probably 4, but I'm going to ignore that. We have got to talk about self-employment.
She's a renegade, Brandon.
Okay, 5. He's giving us that other minute back. We've got to talk about self-employed.
There's no way.
Well, we're going to do it real quick, and she's just going to have to zero in on the do's, the don'ts, and what to do to prepare yourself.
Call Gail.
Okay. On your mark, get set, go. Say something.
Well, the thing about it, call Gail. I mean, self-employment.
Yeah.
I'm getting returns where this year the person filed Schedule C. This next year they filed a partnership. This next year they've got something else. And it's like whoever they're using doesn't really know what they need to file like.
Right.
You know what I'm saying?
Gotcha.
And I think I just think self-employed folks need to really connect with a solid financial person so that they can look at their whole, and maybe it makes sense right now for you to file like this because you're smaller, but some of these businesses take off, boom, 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 and then, so anyway, I'm going to get off my wagon.
Okay, real quick on self-employment, one thing you want to remember is to report your income. You have people come and say, I'm only going to report what they tell somebody sending 1099. Some don't even do that. You got to report your income because IRS is checking that. Take all the expenses you can, mileage, any expenses that you incur to get your taxable income down. If you have a profit, you got to pay self-employment tax, which is like a FICA tax for employee people. So it's very important that if you're self-employed, don't play with the numbers. Don't add income. Some people add income trying to earn income credit. Some try to reduce it so they don't pay as much self-employment tax. Do it right. Come up with the expenses that you really need because IRS is really looking at that.
2 things. Pastors who get housing allowances, how should that be treated?
Housing allowance is not taxable for as income tax, but it has to be self-employment tax. They have to pay self-employment tax on housing. There's ways to reduce that housing amount by expenses that you incurred that was not reimbursed to you.
Okay. And then the other thing is on mileage. I work for a job where I can track my mileage and I work for a job where I can deduct my mileage. When we're doing loans, if that mileage is not appearing on another schedule, I mean, it has to be like the mileage and I don't know, whatever it is. It's on another schedule. We will not we won't let the mileage use the mileage as an offset in the debt ratio, if I'm making sense. So you know how Uncle Sam will pay you so many, or they'll allow you whatever it is, 20 cents, 30 cents per mile?
Yeah,
55 now.
Per mile? Okay. Well, like if a person has a car payment, and then they have this mileage deduction, we can somehow use that mileage deduction to help offset the debt. Okay, but it's got to appear on this one schedule. Do you know what I'm talking about?
Yeah, on the Schedule C, you have for car expenses.
This is not self-employment. This is not real. This is I work for a company.
Oh, you're talking about the 2106.
Okay. It's got to appear on that one form. Otherwise, if it doesn't appear on that one form, then we can't offset it.
Yeah, it's the 2106 is for unreimbursed employee expenses.
Okay.
So if somebody's using their car for the company and they don't get reimbursed, then they can put that mileage on that form, and it's part of your itemized deductions on Schedule A.
And it helps you qualify for a loan, which is why it's important that it needs to be there.
You know what, Gail? I don't know. You might just have to come back.
You do. I mean, that's self-employment. We didn't even touch self-employment.
Exactly. And so we'll do just that. So I know we need to wind up. Please give out your number, your website, especially so people can start receiving your newsletters.
Okay. Okay, my website is barnesfin.com. My email address is barnesfinancial@sbcglobal.net. So if you want to receive that, just email me and I will put it on there. My phone number is 317-663-8452.
And I'm Janis Bradley, your real estate consultant. I can handle all of your real estate needs. New construction for sale by owners. If you're living in a property that you want to buy, obviously buying existing homes or sellers, I can help list your home. My number is 317-590-7348. Diana Rice-Wilkerson.
I'm Diana Rice-Wilkerson. First of all, on March 16th, 2017 at 6:30, I will be with some other colleagues offering a homebuyer seminar, and it's going to be held at the McAllister's Deli, which is in Castleton Square, which I'm understanding is near K Jewelers and Forever 21, and that's at 6:30 at McAllister's Deli. We're going to be talking about the mortgage process, home inspections, insurance, and the credit, and the whole entire bit. Definitely, we want you to come out. My name, again, is Diana. I'm the one that shows you the money. My number is 317-402-5555.
See you next week.
Bye-bye.
You've been listening to Home and Finance with your hosts, Diana Rice-Wilkerson and Janis Bradley. For more straight talk about financing a home and insider information about buying a home, listen next Saturday at 1 p.m. or call 402-5555. That's 402-5555.
The proceeding was a paid program.